Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, everything you need to know in 90 seconds at 9 o'clock, with new stresses in China seem to be building, and quite quickly. Firstly, their trade balance swelled yet again, reaching $50 billion with the rest of the world in June. But not in a good way. Their export growth dipped 1.3%, pretty much in line with expectations, but their imports fell a whopping 7.3%, and much more than expected, and compounding the large May decline. In the sensitive trade with the United States, China's surplus is growing and growing. In the past 6 months, China's exports to the Americans have fallen just a bit more than 8% year on year to just under $200 billion in total. On the other hand, imports from the United States dropped almost 30% to only $59 billion. The result has been a much wider trade surplus with the Americans of $140 billion. On the trade numbers alone, China is the clear winner here, the US Farm Belt the clear loser. But those trade numbers also point to an economy that seems to be running out of the steam that trade once drove. At 2 o'clock today, a raft of key economic data will be released, including second quarter GDP, retail sales, and industrial production, and they will set the tone for China over the next month. And overnight, it became clear that Huawei is hurting more than they're letting on. Giant US contract manufacturer Flextronics, which makes Huawei phones in Changsha, in Henan province in central China, has all but shut down a key plant that is central to Huawei's new product launches. They are laying off staff in the US as well. Of course, Beijing is not sitting idly by as these pressures build. They are making sure debt funding is available, and new yuan loans for June were up 13%, probably at double the rate of their economic growth. China's answer to stress always seems to be more debt. In the US, Wall Street ended last week on a record high, with the S&P 500 pushing up over the 3,000 index level. Investors are preparing for a good earnings season, and the Powell congressional testimony has most investors thinking a rate cut at the end of the month is now locked in. Meanwhile, American producer prices rose only modestly for the second straight month in June, as an acceleration in the cost of services, they were up 2.5%, was offset by cheaper energy, which was down 7.1%. Those falling oil prices mean overall producer price inflation gained their least in nearly 2.5 years at 1.7%. In Australia, it's becoming increasingly clear that savers pay the price for low policy rates. Both ANZ and NAB cut term deposit rates significantly on Friday, as public officials press banks to pass on most of the benefits of the rate cuts to borrowers. NAB now offers a one-year term deposit at 1.75%. ANZ offers that for 1.85%. TD rates starting with a 1 or even a 0 are their future. And Aussie retirees, however, will be somewhat protected. That recent Morrison government budget allocated $600 million to higher pensions over 4 years, or about $1,000 each per year, by rolling back part of their means test thresholds. And the US Treasury 10-year yield will open this week at 2.12%. Gold was up $17 last week to $1,416 an ounce. US oil prices a little changed today. They're now just on $60 a barrel, and the Brent benchmark is just a little over $66.50 a barrel. And the Kiwi dollar is stronger yet again today, and just touching on 67 US cents with another good rise on Friday. On the cross rates, we're also firm over the week at 95.3 Australian cents, and against the euro, we're up to 59.4 euro cents. That all pushes the trade-weighted index to just on 71.7. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.